Hi, I'm Casey Herman, leader of PwC's ESG practice in the U.S. I'm delighted to be here with a panel to talk about climate-related commitments that banks and other financial institutions are making and the impact that it will have on their customers and investees, who are many of you in our audience. To my left is Jason Recate. Jason is Citibank's Global Head of Corporate Banking and Lending. To his left is Brittany Schmidt. Brittany is our banking and capital markets partner and leader of ESG for the banking industry. And on the end is Payush Agrawal, and Payush is a senior risk officer with deep credentials in the banking industry with particular emphasis on climate risk. Brittany, let me start with you. Could you just provide some background generally about what we're seeing in the banking and other financial institutions around net zero and lending portfolio intensity?
Yeah, absolutely. So most of our leading financial institutions have made net zero commitments, and those commitments align with various alliances, including the Net Zero Banking Alliance and the Net Zero Asset Management Alliance. And that is a commitment to reduce their category 15 Scope 3 financed emissions. And that is in addition to commitments that they've made around sustainable finance targets, and that is capital that they're going to deploy to actually help with transition activities in the real economy. Now, they're doing that, Casey, because they're getting a lot of feedback from their stakeholders, their regulators, their customers, employees, that they need to take a stand on ESG matters and that it impacts and drives corporate value.
So, Payush, that raises a good question about the intersection of climate risk and net zero with overall enterprise and corporate risk management, because there's many other factors of risk management that banks have to deal with. Tell us a little bit about how you have thought about that intersection.
Sure, no, thanks. That's a great question. I think the world at large relates to climate risk as a net zero initiative, but climate risk is a little bigger, and I thought I'll spend a minute just going through the background. So when you think about net zero, that's a strategic imperative every company is making now in their commitment to climate. But the way I think about this is, what is your company or your bank's impact to climate that you will achieve through net zero targets? So it's very outward focused across several portfolios. And over a certain period of time, most people have it by 2030 or 2050, reaching certain net zero targets. To me, as a banker, climate risk management, I think, is a little bigger because we have several stakeholders, our regulators included in that, and climate risk management is climate's assessment or impact today to any bank. So if you think of the safety and soundness of the financial system, it's not limited by just one strategic imperative of net zero. It really is broader. And so we go beyond looking at the transition risk of our clients or the greenhouse gas emissions of our clients. We've got to think about the end-to-end infrastructure needed for risk management, which over time, I think both net zero and climate risk will converge, because it's the same data sets, it's the same kinds of things, but you have to look at all of the tactical things of risk management, also in the nature or context of climate risk.
So thinking about climate risk as a systemic risk to the banks and the portfolio and the financial systems, and considering how you build the models to project what that risk may look like and the timeframes, it's obviously a very complex exercise.
Exactly. I mean, I think as you go forward, all of the infrastructure you've needed for what I call quintessential risk management, like credit or market or liquidity, have now going to be embedded some segment of climate risk assessment in each of those. And so even in our own internal treasury portfolios, you've got to think about how does climate affect the value of the securities, which may not be in a company's disclosed net zero assessment.
Brittany, tell me a little bit about how the banking customers are dealing with this issue, because they're being asked to provide information that maybe they're not accustomed to. So what are you seeing in terms of how banks are getting this information and how their customers are reacting?
Yeah, so banks and financial institutions are taking those three topics that we've just outlined, that sustainable finance view, so the tagging of something that is determined to be a sustainable finance lending product, if you will, the view of the emissions profile of that client, which is for the net zero commitment, and the climate risk aspect that Piyush just outlined. They're taking all three of those and they're saying, what information do I need to ask my counterparty for? And that really comes down to additional data. And it also is a little bit of an education session and a back and forth around what is your plan? What is your plan to respond to these macro drivers that are changing the business model that you potentially are operating, or the macro environment and geopolitical environment in which you're operating? And how are you responding to that? So that it's actually a really great opportunity to ask them for information and to engage in a conversation and to offer additional financial support, right?
So related question, obviously it's going to take a lot of information and data flow at the bank level.
Mm-hmm.
How are the banks responding to gathering and setting up the systems to gather that information?
Yeah, data is a challenge. I think the one thing that we usually talk about when we talk about ESG data is it's not a monolith, right? There's lots of different components of the data that's needed. So it's a little bit of directly sourced data from clients. There's third-party data that's available that's improving over time. There are estimation approaches to fill in gaps and holes. And I think that ecosystem of all of that information is what people are trying to really improve, and so that they can make the best decisions possible.
Yeah, so significant infrastructure investment needed to gather, report, accumulate, maintain that data. So, Jason, I've been very impressed by the transparency of Citi's recent commitments, and specifically, you started with financed emissions for two hard-to-abate sectors, the power sector and the oil and gas sector. And ultimately, you're going to roll that out to all 9 of the hard-to-abate sectors. Tell me a little bit about how you thought about that, and how your clients are thinking about it as they're facing those realities or those policies for the first time.
Sure. We identified power and energy, oil and gas, as you say. We set the targets differently for the two sectors. For power, we're looking for a 63% reduction in intensity by 2030. And the 2030 target for the oil and gas sector is a 29% reduction in absolute. And we spent a lot of time on figuring out how we wanted to set those targets and what they meant. For us, it was very important to have science-based pathways, and a lot of transparency, so people can hold us to our commitments and track what we're trying to do. But it wasn't sort of the first solution out of the basket. We spent a lot of time working on where we are now, understanding the type of information we've got about our clients, and working through whether those targets would be achievable and how we talk to clients about it. I think our clients looked at what we were doing, have asked us quite a lot of questions. We spoke to many of them before we did it. We gave them a sense of what we're going to do. We've spoken to many of them afterwards. I think they've appreciated that we put out a target that's understandable, but they also recognize that there's some ambition in there, and there's going to be a lot of work to do. I think our view overall, though, is that this isn't just about finding ways to reduce loan exposure to clients. This is about working with clients through their own transitions. We very much view this as a partnership. We know a lot of our clients, I would say most of them at this point, are working on their own transition plans. So we intend to take advantage of the fact that they're working on these things, provide advice and counsel, even financing where appropriate, to sort of aid in those transitions.
Yeah, I know that you've committed $1 trillion to sustainable financing instruments, which I'm sure is a growth area that you're looking at as well. But one of the things I noted in particular was your plan was very specific about the goals that you just talked about, but also very specific about the actions the bank would take, including potentially walking away from certain relationships. And I think that was distinctive in terms of your level of transparency. And I'm fascinated to understand how you thought about it as someone that has multiple goals to fill, including P&L pressure and growth, but also meeting these goals, and some of the internal debates that you must have faced when you're rolling those out.
Well, you're right. I'm a banker first and foremost. It's not my intention nor my business model to walk away from clients. That's not what we're trying to do here. And we did set out power and energy as the first two sectors we're going to focus on. But this year we're going to add in autos and steel and commercial real estate. Those will be the next sectors. And we have others coming in future years. We're sort of staggering it so that we have some time to adapt and understand what's happening. As I said, the first and foremost idea is to understand the clients. We're going to spend the next 2 years on a deep dive to understand where are our clients now, what have they already decided to do, and where do we think they can reasonably get to by 2030. That's a really important piece of analysis and mathematics. We've got to make sort of an initial view of what we think is going to happen, where they would, if they carry through on the plans they've announced, what are they going to look like by 2030, and how does that figure into our own targets? You mentioned our sustainability finance goal, and yes, we will be putting skin in the game. We'll also be helping clients with financing and advisory where they need help to make some of these major changes, and so the combination of all that we think will be challenging, but not severe in the sense of this is Citi deciding to walk away from clients. Well, it's quite the opposite. It's us trying to engage our clients in a new way, and help them through what's going to be, a business critical change for them as much as it is for us.
So I'm curious how you thought about upskilling your bankers to have those conversations, because those are very different conversations than they've had in the past. How did you address letting your bankers understand these goals and understand the language of sustainability?
Yeah. Sustainability, climate change, all of this is going to be, in my mind, for the current and future generations of banking, almost as important as having corporate finance and credit skills. You can't approach clients going through a massive transition like this without understanding the drivers that are affecting their businesses, just like we would worry about leverage and cash flow and margins in their core operating businesses. So we have to make sure that our bankers across all segments understand this. And we're going to provide the training. A lot of them are really very interested in it already. It hasn't been a hard push. Getting people interested, understanding that our business model is changing. Bankers come and ask for information before we even put it out there. But the other thing we're doing as a firm is substantially increasing the internal resourcing around this. So every part of our firm that touches the topic of sustainability is upskilling. It's increasing the staffing. The resourcing is incredible. When I think of where we were 5 years ago, it's almost a completely different bank. We've got a very strong sustainability group as part of our public affairs team at the top of the house. But we have, within risk management, we're developing an entire team of people who are focused almost entirely on climate risk. And then in banking alone, we've set up a new sustainability and corporate transitions team and their entire focus is on transition advisory, on sustainable finance, green finance, those options, making sure that we have a team that can go directly into all clients and go through their options as they think through the changes they're going to make. And then finally, we did something I think which was quite already showing success, which is we took some different and disparate industry coverage teams and we merged them together into what we're calling a super group. We took the energy team, the oil and gas group, the power group, and the chemicals group. We call it natural resources and clean energy transition. And what's been so far quite, I think, successful about that is we have bankers who are really good and understand their clients and understand the current status of petchem and oil and how power is delivered the energy it needs. And we're asking them to work with another pillar in there of clean energy transition folks to help us reallocate capital, talent, and advice into those sectors that need it most.
Yeah, and it's a challenge because the technology is evolving. Understanding the viability of new low carbon technologies, especially in the energy sector, is crucial to this. And those are capital intensive projects, and I'm sure it provides you opportunities as well as a different view of risk of those technologies.
Totally. Some of this is a leap of faith. We see pathways to 2030, and which are already substantial. If we don't have massive technological change, we'll still make some improvements on what we're doing as a society and certainly in the financial world. But to get to 2050 and true net zero, something else needs to come. We may see a lot more nuclear, but we might see other forms of renewable energy that is great, and we just haven't imagined it yet. But we're going to need quite a lot of that technological change for the world to get to real net zero.
Yeah, it truly is an all of the above.
It absolutely is.
It to maintain reliability and
Mm-hmm.
and the quality of our energy system. So I guess, Jason, one last question. I'm sure that your energy and your power clients saw this coming, but what kind of reaction are you getting from others that may be impacted next year or the following year? And what was the reaction you generally got from your energy and power clients as you went to meet with them and talk about these goals?
I think first we spent a lot of time sort of, if I could put it this way, softening the ground. We talked to them at length. They knew this was coming. We didn't want anybody to wake up one morning, open our TCFD report and say, what's Citi talking about? It was very important to us that we provided a lot of transparency. Nevertheless, there's a lot of detail in there. There was a lot of things to talk about. I've spent time myself traveling around the country and in Western Europe as well, talking to some of our most important clients in the sectors. I think generally speaking, what was great was that they understood the plan. It was clear enough. It didn't lack clarity. They could understand what we were trying to do and why. So then the questions that we were getting were, how do you think about us? What do you think is going to happen across the industry? Do you think we're the kind of client you're going to stick with, or are we at risk? And I think that's a very fair question to ask.
Sure.
But what I found, frankly, heartening was how every client, without exception, developed markets, emerging markets, has been thinking through this already. Mm-hmm. They're making plans. They may lack capital. They may lack some optionality right now, but they're all thinking very carefully about this. I was in Brazil 2 weeks ago. I was fascinated, without me having to prompt, that every client that I met in Brazil, regardless of industry, was talking about their transition plans and their opportunities, and they're very excited about it. So I'm quite encouraged by all that. It's interesting when you talk about clients outside of those two core sectors and how they are asking a lot of questions. They want to know, because I think they're trying to decide what are going to be their sources of energy and power in the future. Do we think this is really going to happen, that there's going to be a massive transition? And, in some ways, the conversation before the invasion of Ukraine is different from what it is now. I mean, there's a whole different set of metrics and different energy prices and different structures for energy security across the world that have moved that discussion into a different place than it was before that. I think that's why it's helpful to have folks across our organization who are entirely focused on this question, who are producing work on it.
Yeah, and drilling into that a little bit more, and Piyush, I'm curious on your thoughts of this. There's an intersection around ESG in terms of energy security, energy affordability, the social impacts that has. How do you think about that as your goals evolve? Because the world does change, and priorities do change.
Yeah, I mean, it's a complex mosaic, right? If you think about what banks are trying to achieve, the mathematical part, as Jason said, is easy. Anybody can get to that. Mm-hmm. I think the primary shift is around culture, and it doesn't mean what somebody senior has committed and everybody goes and chases that, because as he was mentioning, the first naive reaction will be, does that mean I can't service my client with credit? And so clients are nervous, the bankers are nervous. But getting to a target and figuring out the rails that you will lay the infrastructure to achieve that is an uphill task. And as you think about this being a forward-looking statement of where a bank needs to be, data is not reliable or not available in the same way between where what our clients publish, what our vendors provide. A lot of the assessment you're making is around futuristic modeling of GHG emissions as against your own loan book, the pace of transitions happening in the industry. You talked about new clean tech companies coming, being developed every day, and the evolution to get successful is going to be shorter than what you've seen in the past with traditional tech. So I think the culture statement probably drives how any bank is going to perform in this, and hand-holding your client as you're going forward, knowing that you will get a turbulence like the Ukraine invasion, you're going to get oil price up and down, you have local regulation everywhere to protect lower income parts of the population. So the Community Reinvestment Act here and its proxy regulation in almost every country, you've got to be mindful. You can't take mortgages off some low-income neighborhoods because they happen to be in a hurricane belt, because you need to finance mortgages. So how do you balance out your assessment of what those future risks are with what it's going to be? So it's not easy, but I think as long as there is pragmatism in the system and moving forward, and this will keep evolving, data will keep evolving, you'll keep getting better sets of data. Where we are moving away from is making a lot of assumptions to hopefully getting a lot more real-time information. We'll keep cleaning up these models and therefore the assessments of how you want your portfolio to react. I mean, one of the early changes which has been very positive in the banking industry has been, just as Jason mentioned, the bankers training themselves around climate risk. We weren't traditionally trained in climate risk management, right? We learned cash flow and leverage and how do you set the right governance. But bankers are making the assessment and getting better at that. And now when I apply that to some of the tools that are going to be needed to be successful, think about scenario designs and stress test. I don't think a banker knows how to take 3 feet of sea level rising or what that might mean to a pharma company in some part of the world in terms of our portfolio from climate. So now we're evolving to a place of taking climate variables, trying to convert those to banker speak of economic variables, then doing a 20, 30-year future stress test, and therefore what changes you're going to need. But you can't make those changes now. You've got to make those changes, like I said, with pragmatism over 3, 4, 5 years, just so you don't leave anybody behind in this.
So I want to touch on something that both Piyush and Jason said that I think it's an interesting component that we don't talk about enough, and that is it's not like you get a snapshot in time, right? It's you have all of these components. We say scenario analysis or risk management or goal setting. It's a set of assumptions about what we think is going to happen in the future, what governments are going to do, technologies that are going to be available, changes that our clients are going to adapt, our customers are going to take on. And that information is changing all the time. It changes for each geography. It changes for each of the client sectors. It changes for kind of that client, to your point, saying, where am I on the grid? Am I a leader or a laggard, right? So all of these things are dynamic. They're happening all the time. And what that means for us is that we can't sort of stay put, and we have to keep reassessing how the landscape is changing over time, re-engaging in the conversation. But I think the thing that your bank's client should be encouraged by is the fact that means they have an opportunity to re-engage, right? It keeps changing. They have a chance to kind of jump onto the wave. And I think there's definitely some folks who've jumped on recently where potentially, if I look back a year or 2 years ago, they weren't necessarily at the same place. So it's interesting, right? How much it's evolving and how quickly the acceleration, the trajectory has picked up pace.
So, Brittany, just adding on to that, what are you seeing from other types of financial institutions outside of just banking and lending, and what impacts might their actions have on the corporates out there that are their customers?
Yeah, no, it's a great question. We see the entire financial services industry. If you think about GFANZ, right, the Glasgow Financial Alliance, it includes asset managers where you're seeing massive sustainable fund flows. So you see investors wanting to invest in more green assets, right? What that means and the definitions and the scoring around that, I think, is a point of all debate. But the market is there, right? People want their funds to be going into that space. We see it in insurance where, if we think about the impact of physical risk events on insurance pricing and profiles, it's a major issue for them, and they need to really think carefully about that and balance out potential pricing changes and affordability and coverage and all the rest of those items. And then, of course, we've had a lot of the banking conversation. So what I would say is similar to what Jason's seeing in the real economy, the financial services sector is also asking the same questions. What does all of this mean for our business model? What are the opportunities out there for us? What are the risks that are now facing us? And how do we respond?
Terrific. Let's dive a little deeper into the challenges that you just touched on within the financial sector in terms of measuring this. Jason, you mentioned earlier you had separate goals for power and for energy. One was intensity based and one was absolute value. Tell us a little bit about the debates that you had internally and how you set those goals and how you might be thinking about goals for other sectors.
Yeah. Well, I won't go through all the days and days of discussion, but it was, I think what it came down to is it's absolutely inevitable that the world's going to need more power. It certainly does. There is also, a fairly clear trend that we're going to try to move away from fossil fuel as much as possible. Those two facts kind of inform the discussion we had around how to set those targets. The power output is going to increase, and as it does, it's even if there weren't these sorts of financial services encouragement, you could say, to change, power is going to necessarily require non-fossil fuel, probably a lot of renewable, non-carbon emitting type of fuel for itself. And so it seemed quite natural when we thought about power to say, this is going to be an intensity-based discussion at that industry. Let's align with that. Let's understand that there is going to be a massive shift in power over the next 7 years, 8 years, and certainly over the next 28 years. And so that we wanted to align the target with what's going to be naturally occurring. And we don't think 63% by 2030 is a non-ambitious goal. It's ambitious, but we also think it aligns reasonably well with what we expect to see in that sector. On energy and the oil and gas sector, and the absolute decision was really because the flip side of that coin is we need to see generally speaking reductions in fossil fuel usage. Mm-hmm. It's not going to get cleaner. There will be adjustments. There's things, scrubbers in certain types of equipment, et cetera, that you can start to reduce the methane flaring at oil wells and things like that. But it's generally speaking, it's going to be a high carbon intensity product. So if you're serious about limiting the increase in global temperatures to 1.5 degrees Celsius, which is the science-based approach we're trying to take, you sort of have to acknowledge that energy generally has to just reduce fossil fuel emissions, and it's got to happen in a clear way. Intensity, it could work. We understand other institutions are taking a different approach to that, but we felt like that was the most transparent, most clear way to communicate our intentions, and pretty comfortable with that.
So one of the things I picked out of your report that I focused on was that only 29% of your power clients and 17% of your energy clients publicly reported Scope 1 and 2 emissions, which really highlights the data issues that you have in coming up with this. Yes. So I'm curious, from all three of you, how do you see that evolving in the coming years? And I think the SEC's proposed climate change rules that were talked about earlier in our webcast certainly address some of that, but not all of your clients are going to be subject to those rules.
Correct. But I think it's a great step in the sense that we've got to get global standards around the taxonomy and around the reporting standards. This is a good start. This is the U.S. is the deepest, most liquid capital markets. There's going to be a lot of fundraising in this market, regardless of where companies come from. This is going to help, I think, set a benchmark for how you report emissions, and I think that's helpful. Right now, we are operating without a net a little bit. We're heavily reliant on third-party sources of data, people who are using estimates, who are imputing the emissions coming from different companies, more or less based on the size of their business, at a very basic level. It's a start. It's where we're starting. Mm-hmm. We're certainly not saying the numbers we have decided are the baseline in 2021, 2022 are correct, but it's all the best we've got right now. We're going to work from there. As we get better data, better reporting, better disclosures from our clients, we'll layer that into our to our plan and make sure that it's robust enough to stand up to that better data as it comes. But you're absolutely right. It's one of my concerns. Are we operating with the best possible information we have? I think we are, but I really hope it gets better because it needs to be.
Yeah, and frankly, emissions is the easiest thing to measure. If I think about climate risk and asset risk and transition risk, that's even tougher.
Yeah.
So, Piyush, I'm curious how you're thinking about that as you factor that into your thinking about future risk management around climate risk.
Yeah, so data disclosure or standardized disclosure is the absolute lifeblood of how you're going to run net zero goals, or you're going to run your own climate risk management. I'm equally encouraged by the SEC rules. I think it helps. It's a step in the right direction. I'm hoping there is global harmony, that clients around the world and therefore regulators around the world have this common taxonomy, just so that we're not spending different amounts of money for different things, because at the end of the day, it's a global climate. It's not a country climate that we all care about. I think when you look at a bank and a bank's climate risk assessment, risk identification is the first thing that matters. And risk identification doesn't end with just your loan portfolio and where you have carbon intensive or non-carbon intensive. You really have to look at the entire balance sheet and all your assets that are not on the balance sheet. So as much as I care about commercial real estate, I also care about where the bank's own properties are, just in your own assessment. So why would you be building on an oceanside property where you know physical risk is pretty high, right? So all of these matters, but as I go through risk identification into how do you assess risk? And again, data comes in there. Am I making numbers up to assess risk and might be taking less than perfect optimal decisions? Or can I get good quality data? I think Jason touched on the vendors, and in my own climate risk role, met hundreds of vendors, and I'll tell you, the data is very different. In some, one client is probably the most favored, and another, clients in another vendor assessment, the client's probably the most polluting client, depending on their imputed data. Then you get into what you said, ESG. Right now, we've talked a lot about climate, but not the S and not the G. And even the E is not complete for climate, because we're going to get into biodiversity and, more, I would say, variants of climate as you go forward. So all of these are coming together. The good thing is we're at a tipping point. I think where oil prices are right now actually expedites many of these actions that people want to take. And so you're going to see nuclear power, you're going to see other clean technology shape up faster, but you can't go away from your reliance on some of the traditional sources. So the assessment across the entire balance sheet, beyond just the loan portfolio to everything else, is a big part. How you build a scorecard, how you risk rate, your assets is going to be important. And then that's going to play into capital allocation. And that's been always one of the biggest challenging things of where do you allocate, knowing that it's got different revenue outcomes and client relationship outcomes coming from all of that. And then there is risk reporting, governance, taking the data that I'm talking about and building the pipes across the entire organization. So everybody begins with a common taxonomy and common setup, rather than debating my data is right or your data is right in how we look at a client or look at an asset. So there's a lot of things underway. I'm very encouraged with the pace that the industry is on right now. But hopefully, like I said, all of these will converge and we'll get over 2-3 years much more consistent taxonomy and data sets to make those decisions forward.
So, Brittany, how are you seeing our clients react to those needs? Because it is a lot of work and a lot of data and a lot of data management systems. How are others responding?
Yeah, I think the way that they're thinking about it is that ESG topics touch, at least in financial services, right? Every single function, every single business unit, every single process. So rather than thinking of it as a thing that happens off to the side, the way to think about it is that it impacts everything. Mm-hmm. And therefore, each function owner, each business owner has to think about how they're going to build it in to their processes and to their technology and infrastructure in order to capture the right information and look at your traditional financial metrics and risk metrics alongside these new views of drivers of value. So I think the journey that everyone is on is to build that in a sustainable way, such that they have all of the systems and data at hand. And if we think about financial services architecture, as folks on this call probably know, it's very complex, right? If you think about the left-hand side of really embedding this in all of the different products and service offerings, et cetera, and making it available to the people who are doing that job day in and day out, and then aggregating it as it goes across in a global institution like Citi, for example, it's quite the challenge, right? It's akin to the types of challenges we have around financial reporting and regulatory reporting, and this is an add-on to this. So the thing we always talk about is one must have a view of exposure in order to have a view of exposure emissions. One must have a view of exposure in order to understand risk. And it's a challenge, right, to get to all of those different aggregation points. So that's how folks are thinking about it. It's a journey. There's a long way to go. I will say I also see our technology counterparts, right, out there in big tech kind of rising to this challenge. They see the need, they see what needs to happen, and they're trying to build in and provide solutions and service offerings.
Yeah, we certainly see those investments occurring, and it'll take time. As you said, it's a journey, and we're probably in the early stages of that journey, and it'll be fascinating to see where this goes. So with that, I just want to thank you all. This has been a great discussion, and we really appreciate you spending time with us and our clients.
Thank you.
Thank you so much.
Enjoyed it.